Good morning and thank you everyone for being here. I'm Calvin Schnorr, VP Research at NAREIT, and I'm really happy that this morning we have Jay Diamond from Annaly here. Now most of you know about Annaly, a very large mortgage REIT. For people who are not familiar with it, mortgage REITs are a little bit different from equity REITs, but they're a very important part of the business, particularly with everything that's gone on in the mortgage business over the past few years and as we go forward. So Jay's managing director and on the executive committee of Annaly, and he's also the head of research. So with that, I'll turn it over and let's hear what you got to say.
Great, thanks Calvin, and thank you all for coming out today and spending the next half hour or so with me. I'm going to start with some basic background on Annaly, get into a little bit about the risks that we manage and how we manage them, and hopefully leave some time for questions at the end. So, as Calvin said, Annaly is a mortgage REIT. We're the largest mortgage REIT listed on the New York Stock Exchange with a market cap of over $16 billion. And as of March 31st, we had assets on our balance sheet of about $120 billion, primarily agency MBS, which I believe makes us the largest pure-play financier of residential mortgages in the country. So we're dedicated to providing private sector capital through the secondary markets to support American households. We estimate that we fund over 1 million homes in America. Our growth since our IPO in 1997 has been steady and deliberate. It took us over 10 years, 2008, to get from our initial shareholder base about 130 million to 7 billion in capital, and since 2008 we have again doubled that amount. All mortgage REITs are a little bit different. Some only invest in agencies, some invest in agencies and private label securities. Some, as we know, used to originate mortgages. Aren't too many of those left. And there's also commercial mortgage REITs. Annaly, as I said, invests in agency MBS, and one feature of that business model is that we employ leverage to generate a spread between the yield on our assets and our cost of financing. By prospectus, Annaly's leverage is going to run between 8-to-1 and 12-to-1 debt to equity, which it did from inception until about 2007, when the seeds of the crisis were starting to bloom. And ever since then, we have been running our leverage below the low end of our band. At March 31st, our leverage stood at 5.8-to-1, which we've been below 6-to-1 for a couple of quarters now. And we can talk about leverage a little bit later. At period end, the other main metric of our returns is going to be the spread that we earn between our yield on assets and our cost of funds. And that spread will wax and wane as the interest rate markets move through their cycles. But at period end, our yield on assets and cost of funds, which includes our swap position, was 3.21% and 1.51% respectively, for a spread of 170 basis points. Just to give you some perspective, that is above our long-term average for our spread, but it has been as wide at period ends in the mid 200 basis points. But it's also been as narrow as 10 basis points. So it will wax and wane. After taking out the swap marks in our GAAP income, one feature of our financial statements, as well as a few others in our space, the mark-to-market on our swap position runs through our income statement. So most analysts and investors back that out when looking at our returns. And after taking out the swap marks, we generated over 13% return on equity in Q1. And as we like to say, this is one of our highest returns on our lowest leverage in our history. Another way that we like to look at our performance is risk-adjusted. and we look at something called return per unit of leverage. Essentially, you take your ROE, your core ROE divided by leverage, and that's one good way to look at our company, historically, as well as if you're going to try and normalize for the different business models that are employed by different mortgage REITs. And so ours is among the highest in our space. Another risk that you can track in our portfolio is repayment risk. Again, we are buyers of mortgage-backed securities. You can buy them at a discount. Well, not really today, but if you buy them at a discount, you can buy them at a premium. Bonds you buy at a premium, that premium is subject to call risk. And so one thing that, again, you might want to pay attention to if you're looking at us or others is the amount of premium that is in your book. And our unamortized premium as a percentage of our equity is relatively low compared to other companies in the space. It's about 20%. So investing in Annaly has risk. It also has reward, like any company. We've managed through a wide range of interest rate environments since 1997. I think some of the toughest interest rate environments or market environments that any manager of a portfolio of mortgage-backed securities had to endure. I think we're well positioned for where we are today to capitalize on some of the emerging trends in the macro environment. This, I think, is partly due to what is now a relatively conservative stance in our portfolio. Again, leverage, premium in the book, duration. Experience, I think, matters whenever you're looking at a company. And certainly experiences matter for us, and I think our investors have been rewarded with long tenured management, very little turnover at the top. Since our IPO, I think that tenure and that experience has manifested